What if I told you there was a path for mortgage interest rates to drop into the fives in 2026? How does the government shutdown and the delayed jobs reports from September affect the 10-year Treasury yield and mortgage interest rates? This is Brian Wilhelm, Bayway Mortgage, the money man, bringing you another weekly weekend mortgage market update. I've got so much to talk to you guys about today, so I made a list. So first of all, the delayed September jobs report, the BLS data, came out and it was very mixed. 119,000 jobs were added in September, which is great. However, there were some revisions to the reports over the summer, and the unemployment rate has now ticked up to 4.4%. That is the highest unemployment rate that we've seen in 4 years. So what does that mean? Well, last time we talked, there was a very, very slim possibility that the Federal Reserve would lower interest rates at their December meeting. Now, there's a little bit more consensus, and there's about a 70% chance that the Federal Reserve will meet and lower that interest rate. So how is the 10-year Treasury reacting to all this information? If you recall, the 10-year Treasury yield and mortgage interest rates, they're in a slow dance. They have been for 30 years. We see the Treasury yield go up. Typically, we see mortgage interest rates go up, and vice versa. This year has been incredible because the spread between the two has actually compressed, and that's why we saw conventional interest rates this year in the mid-sixes and not in the sevens. So that said, what is the outlook for mortgage rates in 2026? Well, at the last Federal Reserve meeting last month, Chairman Powell stated that they are now reducing their efforts of quantitative tightening. So what does that mean? They've been selling bonds, all right, to unload off of their balance sheet. They're going to stop doing that. The next step could be quantitative easing. So if you recall, think back to COVID. The reason that mortgage rates dropped into the mid twos, threes, that was because of quantitative easing. The Treasury dumped a ton of money into mortgage-backed securities and bonds, and that's why we saw the mortgage rates drop so quickly and so deeply. That's not going to happen again, okay? The economy has to be absolutely nightmarish to see mortgage rates in the twos and threes and possibly fours again. But in order to stimulate home buying, I could see a path that the Treasury will start doing quantitative easing and purchasing mortgage-backed securities. So with the tightening of the spread between the 10-year Treasury yield and mortgage rates and possible quantitative easing sometime during 2026, we could see interest rates drop below 6%. That would be absolutely phenomenal for our business. It stimulates home buyers. It's good for buyers. It makes housing more affordable. Guys, I work when you work. If you need anything over the weekend, pre-approvals, pricing scenarios, please don't hesitate. Reach out. I got your back. Have a kick-ass weekend.